Here we go.
Thank you.
Okay. You're welcome. Okay. So let me, where am I here? There we go. Okay. So we're going to start here with the basics and define credit. So credit is the act of borrowing money with a promise to repay it in the future. A credit report is a person's financial report and documents their credit history. So why is credit important? For lenders, an individual's credit serves as a tool for the lender to determine likelihood to repay the debt as agreed. Employers also use this as an individual's credit report during the background check process in many cases. Insurance companies review credit to determine risk in an individual's character. So a history of good credit may allow individuals to qualify for future credit extensions as well as lower interest rates. So, in the future, depending on how you're treating your credit, you can either hear the words you're approved or you've been declined. Qualified consumers may be able to get lower interest rates on loans and thus help save money. Having a lower interest rate generally means you have the ability to save more over the term of the loan. Good credit is important because it can save you money by qualifying for lower interest rates. In this example here, same loan, $300,000 mortgage loan, 30-year loan, we're talking about 5% interest rate versus the gentleman on the right, same exact loan with 1% lower, 4% interest rate. You can see the savings of interest, $64,159. So just that little bit, the huge savings. Also, there's millions of records reported to the 3 credit reporting agencies each month. And the credit reporting agencies that they're not responsible for information accuracy. They just get what they're reported, what's reported to them. They only report information, again, that's provided by the creditor. It's the consumer's responsibility to verify the information contained in their credit report, that it's accurate, and then to notify the credit reporting agencies about any inaccuracies. So I've been doing this, gosh, over going on 12 years here, just working in this debt repair, debt settlement field. I talk to a lot of folks. Every once in a while, I'll ask someone, what type of credit they have, and they'll say, good, it's late a couple times on a few things, but overall good. And that's just kind of our definition of good is definitely not what the credit bureau's definition of is. Good credit is there are no derogatory report credit issues reported in the past 2 years. Minimum of 3 open trade lines that have been open for the last 6 months or longer. The derogatory credit comprises of any late payments, collections, charge-offs, bankruptcies, judgments, tax or other types of liens, past due medical bills, student loans. Also applying for excessive credit, can also have a negative impact on a person's credit. And finally, inaccurate information, which happens as a result of clerical errors or information from someone else's file gets leaked into ours. Identification fraud is an issue, of course. All these factors can have a negative impact on your credit. This chart here shows the estimated amount of time certain types of information will be reported on your credit report. So as you can see, some information can stay in your credit report for 7 or more years. We just need to be cautious about that and go in with eyes wide open and carefully when we're handling our credit. Many consumers today have some understanding about credit score. Basically, a credit score is a numerical interpretation of how a consumer's credit ranks on a scale. There's many credit score models. The most common that we're all familiar with is FICO. That's what's used, to all the 3 main bureaus that we're reporting to. FICO score ranges from 300 is the lowest score, and then 850 rather is the highest score. And the lower the score, the higher the risk. Credit scores are used by lenders to evaluate your ability to pay debt in a timely manner. There's 3 things needed to create a credit score: at least one account that has been open for at least 6 months, credit activity that has been reported to a credit reporting agency in the last 6 months, and finally, a social security number. Your credit score is based on several factors, and this chart indicates the approximate weight and level of importance for each of the categories listed. There's 5 categories that affect a credit score. 35% of a score is payment history, or said another way, how you pay your bill, on time or not. 30% of your score is calculated on how much money you owe versus your credit limits. We don't want to have too much of our limit used. If you have a $1,000 limit and you're $990, that's going to have a negative effect on your score. You want to keep it, 50% is ideal, really. 15% of your score is determined in the length of your credit history, 10% on how much new credit you have applied. And at last, 10% is determined by the types of credit you have. Creditors like to see a variety of accounts, like an auto loan here, or a revolving loan, a credit card. That just kind of rounds it off. For them, they like a variety. Slide 9. This slide here lists a common slip-ups that can affect your credit score. As you see by the chart, which was developed by FICO, the higher your credit score, the greater the negative effect on your score as a result of these common credit mistakes. In other words, the bigger you are, the harder you fall. So if you have a nice, strong, really high credit score, and you have one of these occur, your score would fall harder than if you had a lower score. A foreclosure can negatively impact a score of 780 and above by 140 to 160 points, lowering your score to 620 or lower due to other impacts that may also affect the score. So again, just be cautious. It all is repairable, but it can be frustrating. So just be again, when you're dealing with your credit, just do it eyes wide open, knowing that the effects everything will have on it. Okay, so what are the steps you can take to help ensure you have good credit? There are 3 basic steps. First, avoid the common slip-ups and mistakes that we just discussed. Second, obtain a copy of your credit report and review the information to ensure accuracy. And third, correct any mistakes or inaccuracies, of course. Everyone's entitled to a free credit report at least once a year from each of the 3 major credit reporting agencies, or also anytime you've been denied credit. So if you've been denied a credit card or a loan, you have the right to get a free credit report. Now, be cautious about websites that offer free credit reports because you need to make sure to read all the disclosures and fine prints. Free credit reports do not include a credit score, right? There's usually a fee to obtain your credit score. The free credit reports will issue all your creditors, your balances, your payment history, all the stuff you need except the score. And of course, these are the numbers to call to get it. There's 3 credit reporting bureaus: Experian, Equifax, TransUnion. Those are the 3 big guys. So each one, you would want to call each one every year because some creditors are not reporting to all of the bureaus for some reason. Most of them do, but some don't. So just to ensure accuracies, I would call each one, get a credit report from each one, once per year, again, or each time you're denied credit. Step 2 is understanding how information in your credit report is organized. Basically, your credit report is organized into 4 sections. Biographical information section will list the names under which you've applied for credit, current and previous addresses, your social security number, and employers. Next is the credit account information section, which shows the dates the account was open, the current limit and outstanding balances, the terms of the account, and the payment history. And if you have a lien or judgment, the next section on your credit report will list those details. The final section shows who's been looking at your credit report. I'll go into details about credit inquiries in the next few slides. So what is a credit inquiry? There's 2 types. A hard inquiry is created when you give a creditor permission to pull your credit report. For example, when you apply for a credit card and you fill out a loan application, there's usually a section authorizing the creditor to pull your credit. That's a hard pull, a hard credit. Soft inquiries are usually made by current creditors that may look at your credit during an account review just to see how you're doing, or by creditors that may want to extend an offer of credit to you. You probably get those offers in the mail. For example, a pre-qualified creditor offer might say you've been pre-qualified for a credit card or loan. They just did a soft look at your credit just to see how you're doing. That's a soft pull, so that does not affect your score. You can manage credit inquiries and remove your name from pre-qualified credit offer solicitations by contacting the consumer credit reporting opt-out number listed here on this slide. By making it a practice to regularly review your credit report, you can help ensure that no one's accessing your credit file without your authorization. If you don't recognize an inquiry, you have the right to call the creditor to obtain more information about this inquiry. Keep in mind, sometimes creditors may use another company to pull your credit, so the credit inquiry may appear under an unfamiliar name. But still, we want to know, so it's better to call just to make sure that no one is accessing your account that shouldn't be able to. For additional information and resources, visit the FTC website, which is not on the slide, but it's very simple. It's just ftc.gov, ftc.gov. So far, we've covered quite a bit of information, including the definition of credit, its importance, credit scores, inquiries, and the types of information contained in your credit report. Make it a practice to order your credit report at least once per year or whenever you're denied credit. As I mentioned earlier, the credit reporting agencies receive millions of records each month, and it's inevitable. Mistakes can be made eventually over time. It's up to each of us to ensure that the information contained in our credit report is accurate. Once you've ordered and reviewed your credit report, it's important that you could contact the credit reporting agencies to correct any errors or inaccuracies. Keep in mind, not all creditors report information, as I mentioned before, to all three of the credit reporting agencies. So it's wise to order your credit report from each of the three credit reporting agencies. You'll need a current copy of your credit report in order to file a dispute and correct any discrepancy that you might find. It's also wise to follow up directly with the creditor to correct any errors, since the creditor is the entity that provides that information to the credit reporting agency. So you want to go to the source to correct it also, so it doesn't happen in the future. Now that we reviewed the credit basics, what are the steps to help rebuild your credit if you've experienced a hardship? Our truth is there's no easy way out, right? It takes time and patience to rebuild your credit, but the main thing is you have a plan. Right? You develop a budget to keep track of your spending, pay your bills on time, and pay down your debt. Don't apply for unnecessary credit cards, and don't overextend yourself financially. Just common sense stuff here we're talking. Knowledge is power. So if you're declined for a loan, ask for the exact reason as to why. So you can develop and grow that weakness that you have and fix it. Because if you don't know, you don't know. Ask which factors weighed the most heavily toward the denial of your credit. Now that we've reviewed the credit basics, what are the steps to manage your credit wisely? This is a common thread here. Check your credit report at least once a year, and anytime you're denied credit. Consider signing up for a credit monitoring agency. There are many credit monitoring services available that will help you keep track of your credit, notify anytime your credit changes. Be sure to research these services. Make sure you're getting the best price. There's a lot of options out there. When correcting errors or inaccuracies, make sure that you work with both the actual creditor that's reporting the information to the credit bureau as well as the bureau itself, and to help keep you on track, develop a budget that you can live with and stick to it to ensure that you can pay your bills in time and pay down your debt and keep you out of stress. If you co-sign for someone on a loan, keep in mind that you're responsible for that payment if the person is unable to pay. For only co-sign on a loan, I see this a lot with car loans, especially with parents with helping with their kids or other family members. You're responsible for that loan. Just remember that. So if they can't make the payment, you're on the hook. Otherwise your credit score will be negatively affected if you're not paying and they're not paying. You're going to take a hit on that credit. So if you're co-signing for a loan, worst case scenario in it. So can I afford this if they default? Be realistic, and you'll save a relationship too. If you feel managing your credit may be an overwhelming task, you can always work with a reputable debt settlement firm agencies like DebtMerica. That's what we do. Provide credit solutions for clients experiencing financial hardships. Before meeting with a debt consultant, make sure you know what your goals are, though. And is it improving your credit score? Is it paying your debt down? Is it all the above? Is it something else? You want to make sure you have a realistic expectation. Okay? Things are not going to improve overnight. But again, with a plan, you can rebuild your credit. It's definitely doable. There's 5 important things to remember about credit. First, credit scores provide a quick snapshot of your credit risk. Second, the credit report the credit reports that you order yourself do not affect your credit score. That's considered a soft pull. Third, the higher your credit score, the lower the credit risk. Fourth, a low credit score may affect your ability to obtain a loan, employment, or insurance. Finally, you can protect your credit by knowing what's on your credit report. Now, there's many laws that protect consumers. Some include the Equal Credit Opportunity Act, Fair Credit Billing Act, Fair Credit Reporting Act, and the Fair Debt Collection Practices Act. These are all have been developed over the last 10 or 20 years to ensure that you're being treated right. So if you feel that you're being a victim of one of these, again, use one of the numbers that on the previous slides to file a complaint and make sure you're treated right. And that's it. Congratulations. You completed this course. Amazing. This early in the morning. Well, for me, I'm on the West Coast, so it's early for me. But you've taken the first step to understanding and managing your credit. So the next steps, we just encourage you to use the tools and resources covered in this course. If you contact a debt professional, do so. You can go to getftc.gov. We'll give you some options. Niara will help you out with that as well. Right. And I'd like to thank everyone for spending part of their morning with me. That is it.
Well, thank you, Mr. Tony, for doing that presentation for us. I know I definitely got something out of it. That slide where you were showing the impact of different things on the credit score and how it was affecting it worse if your credit was higher, like your score was higher. I was like, why would it do that?
Yeah, that hurts too. That hurts when we work so hard to get our credit score, one little slip up. But it's all fixable. That's the good news. You can always climb back.
Yes, well, thank you so much. I will make sure that everybody gets your information. I can drop it in the chat so that if they have any follow-ups, they can do that with you on credit. But I definitely am going to emphasize the debt consolidation as well, because that might be, I feel like sometimes for people that might be a barrier between them being able to afford a house as well, to get their debt down, to get their debt to income ratio where it needs to be.
Right. Yeah. Because some people forget the debt to income ratio part. They focus on the credit score, but you need both.
You need both.
Yeah. Well, thank you so much.
Well, thank you. Are you going to stay on for the rest of this? I know you
just said I have actually another training, so I have to go. But again, thank you for letting me share part of the morning with you.
Okay. Can you switch the host back to me and
Sorry, I'm looking for the option here. Usually I see it.
if you go on participants and then you click, I think, my name and the little dots that show up, you can switch. Oh, actually, I didn't know this. I can, yay, there we go.
There you go. All right.
Bye.
Thanks
thank
again.
you.
All right. Bye.
So guys, now we're gonna switch over into the first time home buyer portion. So thank you so much for sticking with us. Let me go. You guys are gonna ignore my 85 tabs, okay? It's a thing I do. Okay. Let's, start at the beginning. Okay, can everybody see the screen? Okay, good. I see thumbs up. Well, I would like to say again, thanks for coming to this class. And now we're moving from the credit portion to the first time home buyer portion. And Krystal is my business partner on here. I just wanted to make sure that I made mention of that. So she is here in support of this as well. And Kimberly, please feel free to unmute if you want to ask questions, as we're going through, or Josh, anybody. Okay, so welcome everyone. Our goal in this class is to make sure that you're positioned for home ownership. And we want you to feel confident and comfortable in the process, and a little bit more confident and comfortable with me and Krystal, so that we could help you through this process. So this is the roadmap to home ownership. We're going to explain who we are, what we do, go over some of the top concerns of first-time home buyers, explain some of the benefits of home ownership. We're going to do a case study on a traditional style of first-time home ownership. There's so many different ways. Can't say how many different ways you can get to home ownership, but the traditional style is what we're going to go over today. And we're also going to go over within that, the process, and then do questions and give you information on how to reach us. So who we are, I am Niara Brown. I'm a real estate agent. I cover the state of Georgia, in Atlanta and Middle Georgia. I have done a little bit in South Georgia, but Atlanta and Middle Georgia is where I do most of my business. And I'm also a financial strategist, so licensed in the financial industry as well. And Miss Krystal Parks is an agent in Georgia and Florida. So if you have anybody or know anybody, or even yourself, who would like to purchase in Florida, hey, she has you. Her grounds are usually Atlanta in the Georgia side and Orlando in Florida. So some of the top concerns that a lot of first-time home buyers face, one of them is affordability. So you may have limited savings for a down payment and closing costs, and may also have limited income to cover mortgage payments and ongoing maintenance expenses. So, there are a lot of different factors that affect affordability. But one of the things that we want to conquer in this is helping you bridge that gap. So that's why I did the credit. That's why I had Tony on with DebtMerica, so that you guys will also know that there are other companies out here that help us bridge the gap to get you to home ownership. There's also down payment assistance programs that are very much so, like, everywhere you can qualify for them. There's so many different ones. Some of them are based on location, but when we get down to you and what you got going on personally, we can help you find the right program for you. Location. So you may be looking for a home that's close to work, or your family, friends, good schools, or other amenities. And, that's a really big part to make sure that your location fits with the affordability. And that's one of our big responsibilities as agents. Home size and features. I can't say this enough and with enough love in my heart. Your first home may not be your forever home. And since we know that your first home may not be your forever home, we want you to know that when you buy your first home, it does need to be a home that you're comfortable with. We're not saying just get anything, but a good home for you, and one that you can live in for a while so that you could be building cash value in it. Equity, we'll get to that later, but building cash value in it so that when you are selling this home, you have the money you need to buy the new home without any issues. And so financing options are another big concern that come up in the realm of first-time home buying. So the Federal Housing Administration has protections in place for the conditions of the homes that can be coupled with down payment assistance. And so that means when we're helping you find a house and you're a first-time home buyer, and it's called a FHA loan, which is the Federal Housing Administration, they make sure that the home is suitable for you to live in. You can't purchase anything with an FHA loan that's not in good condition. And that's the typical loan that you'll get as a first-time home buyer. So what are some of the benefits of home ownership? Anybody have any ideas what some of the benefits are?
The number one thing that comes up for me is just the equity in it.
Absolutely. There is no equity in renting. There's not one bit of equity in renting. So home ownership allows you to actually be paying towards getting something that has cash value and that you own. So each mortgage payment you make is broken down into pretty much interest and principal. And I'm not going to get too deep into that, but every principal payment you make within your mortgage is going to bring you cash value.
But then also you can like add on to a home and then make your value of your house go up even more.
Absolutely. Absolutely. Even doing small renovations can increase the value of your home, like changing the cabinets or updating a bathroom or fixing windows. I mean, like even the smaller things can increase the value of your home exponentially. You wouldn't imagine what changing or getting rid of wallpaper can actually do. Um, and then another big portion of this would be control. So you can fix things when you want, and with who you want to fix them. And you can do whatever you want to do pretty much within reason on your own property. So that's another great thing. So I remember when I was growing up, we were staying in apartments, I always wonder why we always had to have white walls. I go to other people's places and they have pretty colored walls. I was like, I want to color the walls. I want to like paint. I was like, well, we can't paint. We rent. And I was like, oh, okay. So even something as simple as your wall color, you have control over that when you're in a home. And so our case study today is going to be with Casey and Judd. And we're just going to go through the simple traditional buying process, meaning we're going to go through this as if they are getting an FHA loan. So here we have Judd and Casey's profile, I'll say. So Judd is a paralegal and Casey is a teacher. They're both making $50,000 a year. Judd's debt is $65K, and that's a combination of student loan debt and personal debt. So credit cards, $50,000 in student loans and $15,000 in credit card debt. Casey's is $69. So she happens to have a vehicle that she's paying off right now. She has student loan debt and also credit card debt. Now, Judd's credit score is a 600 and Casey's is a 650. And after we look at everything, so basically taking their income, taking out taxes, taking out their debt payments each month, Judd has about $2,541 and Casey has $2,491. And if you look down here at the bottom, they have a combined $5,032 at the end of that. And so now I want you guys to take a look over at the left side, getting pre-approved. So these are the things that the bank is going to look at when they give you, when they're determining what you can afford. So when you are looking for a home, you get to, go to a lender. In the state, well, anywhere, you can apply to 5 lenders within 30 days without that having a negative impact on your credit score. So, Tony was saying that your inquiries can also lessen your credit score. Well, they allow you to do 5 different lenders, and that could be private lenders, however you want to get to it, but banks are usually the way. I always encourage people to go with a bank that they're already banking with first, if they have mortgage lending options, because that way you already have rapport with that bank. And 9 times out of 10, guys, 9 times out of 10, the bank that you're already banking with is going to give you better options than anybody new. So you can apply to up to 5 lenders with that only being 1 inquiry on your credit score if that's within 30 days. Secondly, your income determines how much house you can afford. So they're going to look at this 50K and 50K that they're making, and that brings them to like 100K. Now they're going to look at the debt to income ratio as well to determine that number. So they only want, out of the income that you're bringing in and the debts that you have to pay, they only want that to be 40% of your check each month that you're dedicating to debt payments. And your credit score impacts your interest rate. And if you know anything about interest rates, there is a massive difference in payment between a 3% interest rate and a 6% interest rate. Okay. So this is why I'm saying, let's make sure we have credit in order. Let's make sure we have our debt in order so that we can get the best options when it comes to getting our first home. So Jen and Casey are actually doing pretty good. They went through Regions Bank. They chose to go with them because they're already banking with Regions. And then what Regions told them is that, hey, we'll give you $310,000 to shop with. And that means their mortgage would be about $2,190 per month. And their debt to income ratio is about 30% based on what they have going on right now. And then the bank allowed them to get to have a 6% interest rate. So yes, your credit affects your interest rate, but the actual market and what's going on in the market currently affects your interest rate as well. So the government sets the rates and then everything trickles down from there. So right now in this economy, if you guys are aware of what's going on in this economy, we're at a 6% interest rate. Whereas in 2020 and 2021, we were seeing like 3 to 5% interest rates. So a question I always ask my clients is, how much house can you actually afford? If you remember earlier, I was speaking on the fact that I'm actually licensed in the financial industry. And so that means I have a fiduciary responsibility. And the fiduciary responsibility is to make sure that I'm recommending to you the best recommendation that I can possibly do with integrity at all times. And so Regions Bank said you had $310,000 to shop with. That's wonderful. But is that $2,190 payment each month going to be what's most effective for you and your family? So that's the question I like to ask. So in this situation, the bank said, all right, we're going to give you 310. Your mortgage is $2,190 and your down payment would be $10,850 because an FHA loan is 3.5% of the home purchase price, which would be your down payment that you need in cash. And after I sat down and talked with them and looked at their finances and what they're spending money on each month, I said, you guys would probably be better off with a home that's actually $250,000, which would give you a mortgage of $1,830 each month. And your down payment would be $8,750, which is even better because they only had $7,500 saved anyway. So we're in a buyer's market, which is a beautiful thing. So that means sellers are more willing to negotiate on prices. You can request more things like sellers paying a portion or all of the closing costs, as well as homeowners insurance and home warranties. So what we do as agents is we use our expertise to do strategic searches, to do strategic showings, to write effective offers, and to negotiate. And I promise, if you feel like, agents aren't important for those first three things, the negotiation part is where you're going to need us the most. So we went through the process with Judd and Casey, and we found a house that they really loved at $280,000. Myself as an agent did something called a comparative market analysis. And I looked at other homes in the area and saw what they sold for and did a little research into the tax record, saw what the house was purchased for, yada, yada, yada. So I came up with a price that I believe would make the sellers happy, but also save my buyer major cash. So we actually offered at $265,000. And the sellers were like, okay, we'll go with that. Now, once they've accepted, our offer, we roll into a due diligence period. The due diligence period that we all agreed to was 7 days. So that gives us 7 days to do an inspection and appraisal. The appraisal is when the bank, in this case, it would be Regions Bank because that's who they went with, will send out an appraiser to assess the value of the property. That appraisal came back at $268,000. Now, when you get to a point like this right here, this is where negotiations really begin and where you have some kind of leverage. So we said 265. We could have stayed at 265 and just been like, hey, that's what we said, that's what we're going to leave it at. The 268 analysis for the appraisal is super important because this means that Regions Bank will not give us over $268,000 for the house. So you remember Regions Bank said we had $310,000 to shop with. We do have that. They still have that. The problem here is that when the bank said the house is only worth $268,000, that means they're only going to pay $268,000, no matter what the market price is. So the seller at this point could be like, hey, no, I want my 280. I'm not going to go with your offer. And then we have some recourse there. But this is where negotiations start. And where we ended up with was accepting the $268,000 appraisal. So that means Jen and Casey said, okay, we'll do the 268. They came up on the offer 3,000. And what we did was we asked for, hey, can you contribute to closing costs, seller? And also, can you contribute to doing a few other things like doing a home warranty for 2 years, which means home warranties are things like if something goes wrong in the house. So let's say the refrigerator came with the house, the washer and dryer came with the house. If they're going to pay up for 2 years on the home warranty, if something happens in the first 2 years, the seller has been paying for the warranty. So you only have to pay the deductible as a homeowner, which with American Home Shield, which is one of the companies I always recommend, your refrigerator breaks, refrigerators right now can be up to $3,000 plus. Your refrigerator breaks, you're only paying $50 to get it replaced. And they replace with a like refrigerator. So they're not going to downgrade you. They're not going to upgrade you either. They're going to give you a like for like. And so, those kind of things are things that we negotiated in this kind of contract. We got the earnest money at 2%. So, I told you your down payment is 3.5%. Well, 2% of that is what you have to present as earnest money to show the seller that you are ready to do this deal. The down payment at $268,000 comes to $9,380. And, I said that a little earlier that they only had $7,500 saved for a down payment. Well, as soon as I knew that, and we had gotten through all the financial stuff that we talked about together, Judd and Casey, I went to Casey and I said, hey, Casey, how likely is it that you or Judd's parents would support you in this venture of buying a new house? And Casey was like, oh yeah, we could probably get their support. What kind of support are you talking about? And I'm like, well, they can actually give you some money down to help you with this down payment. And it can be a gift. And she said, okay, I'll talk to Judd about it. We'll see. And I'll get back to you. I said, okay, cool. Now, Judd said he didn't really want any extra help. He was like, I'm going to be able to do this. I'll make sure we have the money by the time we're closing. So we have here the down payment of $9,380. And then the sellers did cover some of the closing costs, but not all. So that means we have a total of $11,000 that Judd and Casey need to bring to the closing table. Well, luckily, after they paid for their home inspection, we were able to actually get a gift from their parents of $4,000. So they were actually able to purchase without even having to dip into the extra money that Judd found. So that's really great. So they have a little bit of a nest egg as they're going into the house. And the wonderful thing about gifts is that anybody can gift you. I wouldn't say anybody, but a close personal friend or family member can gift you up to $10,000 for a down payment on your home. Now, the very, very important thing about this is that the money has to be tracked. When you're going through this process of buying a home, the lenders are watching your bank account. They're watching what you're doing as you're going through this process. So any money that comes up unexplained needs to be explained. If the $4,000 came in without any kind of trail, the lenders would have red flagged it and stopped the entire operation. So with me being who I am as an agent, I made sure that I spoke with the lender at Regions and let them know that a payment was coming through to their account from their parents that was going to help them with their down payment, so that everything was going to move smoothly and we weren't going to have any issues at the closing table. And so now that all of that was done, we were able to pay for everything and we were able to close on the house. The next two things that happened are my favorite two things. Them taking possession, so Jen and Casey living in the house, and then them sitting down with me one more time to make sure that the house is protected. Because let's say anything should happen to Judd or Casey, we don't want either one of them to have to lose the house because they can't afford it on their own. So they sat down with me and we came up with a little financial plan to make sure that they were able to keep their home in the event of anything happening. So we have happy first-time home buyers, and we're happy and we're eager to help you get into your first home. This is Judd and Casey's story, but what will yours be? I would like to encourage you to leverage our expertise and relationships in the real estate industry to navigate your way to home ownership. And I really wanted to just review this really quickly with you guys, just so you can see the effect and the way that all this went. So the bank said they were granted $310,000. The mortgage on that would have been $2,190. And the down payment would have been $10,850. I said their best option was to get something that was $250,000. And that would give them a mortgage of $1,830 and a down payment of $8,750. Jed and Casey ended up purchasing something that was $268,000 with a mortgage, leaving them with a mortgage of $1,941 and a down payment of $9,380. So this is what they wanted. And I'm telling you guys, every single time, it is what you want. I give you the best option just so you are aware of what could affect you or what would be the most manageable situation, because this $1,830 per month is actually only about 30% of what they were bringing home. So they still would have had 60% of their cash to spend however they want to or need to. So, 1,941 isn't that much more, but I think having this discussion right here always affects the outcome so that you're not sitting here at 310 struggling every month. So, are there any questions, guys?
I have a question.
Yes, ma'am.
So just for clarity, the bank, so they went to the bank and the bank approved them for $310,000.
Mm-hmm.
Okay. But then you were saying something about if they go with the house that was 268,000, then the bank will only give them the 268,000.
Exactly, because of this part right here, the appraisal. So the appraisal is very, very important because the house that we were speaking on here, the house on the market was listed for $280,000. So like you're on Zillow, you see a house is listed as $280,000. When we wrote the offer, we wrote 265. But when our offer is accepted, what the bank does, because ultimately this is the bank's money, right? They're giving you to get the house. The bank sends out an appraiser. The appraiser works for the financial institution, so the bank, and they say what the actual value of the house is. And it was appraised at $268,000. So no matter the fact that they gave them $310,000, the bank was only going to pay $268 because that's how much it was worth.
Okay.
To them in their eyes. Now, I guess they give additional clarification. If they had found a home that was $310,000 and it appraised for $310,000 or appraised for even more, they still would have been able to they would have been able to use the loan however they wanted to. But you can't go over the 310, and when it comes down to an appraisal, they will not pay over.
Got it. Okay.
Yeah. And I think another example I can give you for that, like real life example, is I was dealing with a buyer, and the house appraised for less than what the asking price was. So the asking price, like in this situation, 280, and then it appraised for like 270 or whatever. And what they did was they actually paid the difference in $10,000 to get the house. So they did use the 270 because they used 270 because that's what the appraisal said, but they paid the additional $10,000 over to the seller so that they could get the house that they wanted.
Okay.
So yeah, that's how that can also go as well. Any other questions?
No, that was great. I appreciate it.
Yes, great job, Niara.
Thank you. Thank you. And so, this is, who we are, Krystal and Niara. We would love to work with you to get your first home, second home, whatever home you're on right now. And like I said, this was just one option. This was the first time home buyers option. We didn't cover anything to do with, rent to owns or sub twos or anything else fun that you can do to get into a house. This is just the traditional way. So what I want to do here is stop sharing my screen really quick, and I want to put into the chat Mr. Tony's information so that, oh, thanks, Josh. I see you said it was very informative. Thanks, guys. I am going to put his information in so that you guys can reach out to him just in case you want more information on the company DebtMerica and debt consolidation or their credit services, because I know they have credit services too. I just don't think he went that deep into it today. And that is his number, and his email address is And Krystal, if you want to, you can drop your information in the chat. And I'm going to make sure that you get a copy of this recording, Kimberly, because I believe you gave us your email address on Eventbrite, so I can email you a copy of the recording.
Okay. Because I also want to ask you something off of this about my personal information.
Oh, yeah, sure. Absolutely. I'm about to put my information in right now.
Okay.
So that way you have us.
Niara, are you from Macon?
Yeah, I'm in Macon right now. So I grew up in Warner Robins, and now my family's in Macon, and I travel back and forth from Atlanta at least twice a week.
Okay. No, I recognize the zip code. I grew up in Macon, so.
Yes. Where are you at now, if you don't mind me asking?
I'm in Atlanta off of Cascade Road.
People know that area very well these days down there in Cascade.
It can be a little rough sometimes, but
It can be.
yeah.
It's still a good area, I like it. But yeah, we can definitely talk offline. And I again want to say thank you guys for showing up and participating today. And one more shameless plug. We're going to continue doing classes like this. And we've done another one previously that was protect your assets. And then we did another one that was what was the other one? Fatten your assets. Yeah, so fatten your assets, protect your assets. This is now the first time home buyers with credit. And
we're also going to be doing a live rent free, and it's pretty much house hacking. I'm more on the investment side. That's where the fatten your assets come in. That's more investing. And yeah, the next one is going to be the live rent free.
Awesome.
Okay, sounds good. I appreciate it, ladies.